Good morning to everyone. So today we'll just have a quick look at Phillip Morris, since they had announced their intention to acquire Swedish Match, but we'll also just touch base on the impact that Ukraine has had on the company. So for FY22, we're expecting to have negative growth numbers in terms of revenue as well as EBITDA, and this is on the back of Ukraine and Russia tensions. So the impact has been close to 20% of next generation products volume loss. For 2022, things are not looking good for Phillip Morris when you look at them before the acquisition. Now, when you factor that in and assume that the acquisition will actually be included for the full year of 2022, we see revenue and EBITDA growing at around 5.3% and 2.9% respectively. In terms of the rationale of the deal, we are positive on the acquisition, and this is because of a couple of things. First being the re-entry into the US market for Phillip Morris. Also, this will actually accelerate their target of having around 50% of revenue coming from NGPs as of 2025. Also, if you look at the income statements of both companies, you can see that Swedish Match has been growing aggressively compared to Phillip Morris. So there's the margins, so they are higher compared to Phillip Morris. So net for net, we see this as an earnings accretive deal, as your EPS actually moves from the expectation of around $5.62 in FY22 for Phillip Morris alone to around 5.77 USD when you include the acquisition. The only risk that we want to highlight, firstly, is the overhang on the sector that stems mainly from US as well as the Europe, where they want to ban your vaping or e-cigarettes in the industry. While this is, like I've said, a sector overhang for Phillip Morris, we don't see this as a high risk, given that their IQOS product is actually better than your vaping products in terms of the nicotine content. But going forward, more long term, is still a risk, as ultimately these regulators want to do away with your traditional tobacco or cigarettes and move more towards your risk-reduced products, or NGPs. The other risk is when you factor in Ukraine, there might be slow growth in terms of NGPs, so the company might not necessarily meet their target of having 50% of revenue coming from NGPs by 2025. So overall, we have lowered our recommendation to a hold, and this is on the back of so our intrinsic value is at around 103, which gives us a potential upside of 4.5. But also on a PE basis, the company now looks expensive. So here I just wanted to give sort of a quick snapshot at Swedish Match. So you can see there that actually they are a key player in the US market, especially in the healthier alternatives. So they have around 67% of their revenue coming from the healthier alternatives, with only around 23% or so coming from cigars. As I've said, the company has paid a premium for this deal of around 39%. They are paying it using debt. So they're paying around 16 billion USD. It affords them a re-entry into the US market. Also, it helps them accelerate their NGP strategy. Now, in this slide and the next, we just show the growth rates of Phillip Morris as well as Swedish Match. So starting off with Swedish Match, it's clear that they've been growing ahead of Phillip Morris. You'll see that in the next slide. But here we just highlighted revenue growth that we're expecting for FY22, as well as how it's done if we look at a 5-year average. Also, same thing for your EBITDA. So here, again, it touches back to what I spoke to earlier, that we're expecting a revenue decline of around 2% for Phillip Morris. Also, if we look at a 5-year average, the company has actually trailed your Swedish Match, coming in at around 0.8%. 5-year average. EBITDA growth also for FY22 is expected to be down by 4.5%. And then on a 5-year basis, we have around 1.5% growth. So we've actually done a Proforma statement. So I think the key takeaway here would be the EPS as well as your, I suppose, margins. So we're expecting your EBITDA margin to average at around 45% for our focus period, which ends at 2024 for the combined entity. Also on an EPS, the main thing wanted to show here was that this deal is actually accretive to the company, as for instance, for your Phillip Morris, you're expecting your EPS to decline by 3.9% for FY22. But if you actually look at the combined entity, your EPS only declines by 1.2. Post the acquisition, we're expecting the combined entity to have a revenue split where your NGP now accounts for around 35%, up from the 29% that we saw in FY21. So again, this is positive given that the company is actually hoping to achieve a 50% split by 2025. Since the company used debt for this acquisition, we've actually looked at the balance sheet just to see if there's any concerns that we have immediately. So if now you add the 16 billion that they're going to pay for the acquisition, you will come at around 40 billion. So the debt schedule was before the acquisition. So what's clear here is that for FY 2022 as well as FY 2023, there's only around 8% debt to be repaid yearly. Also, on your net debt to EBITDA, it does grow, but it's still within their 3 times sort of target. So it will now come to around 2.8 times in FY22. So if we look at the valuation of the company, so the main thing here is we've actually used a 5-year average of the multiple that excludes the deal to value this company. And this is because from the guidance, the deal was supposed to close in September of this year, but it's still pending regulation. So if we use that conservative take on it, you come at a valuation of around $103 USD, which gives you a potential upside of around 5%, which we think is a limited upside. And then for the bear bull case scenario, that's just 1 standard deviation up and down. This just shows what I've just spoken to now in terms of scenarios. But what's interesting to note is that given that Swedish Match trades at a higher multiple compared to your Phillip Morris, in the long run, there is a potential re-rating that we might see where Phillip Morris now trades closer to the Swedish Match multiple that we've seen. And this is because of also them moving more towards the healthier alternatives, which have a higher margin. So when that happens, now you would have a target price of close to around 138, in which case, as we monitor this deal, would then upgrade the company.